As I say there in the headline, look, Wellington values are rising slower, still going up a bit, but not quite the same strength in terms of general sentiment. It's coming through in several measures there, but the values are still firming. Market generally still, I would call it, it's moved from what was for a number of months a decent kind of seller's market into barely a seller's market, more balanced, still on the seller's side, but only just. Values rising slower as a result. The message to sellers is, yes, still just a seller's market, but it's kind of more balanced. And buyers, I continue to say, don't wait for things to improve. I don't think they're going to get any better for buyers. Although the little bit of heat that we were seeing late last year sort of has dissipated a bit, somewhat. So let's crack into the details. Median sale price here, so 760 in January versus 765 a year ago, down 1%. Obviously, so let's call it broadly even. I've been saying for quite a long time now that median sale prices had plateaued since about July of 2022. So that's, 19 months, I think that would be then. You can see from the shape of the graph there, the blue line, the blue bar chart is the monthly results. So, it bounces around a bit, of course. There's been a decent trend upwards in the sort of 6 months to December, then a downward drop there in January. January can be a bit of a funny month, of course, because new listings stopped coming on sort of early-ish December. And so it is not a typical kind of free-flowing listings coming on and sales going out. So January often is a bit strange. But anyway, the trend there you can see from the red line, it's clearly hit the bottom, it's plateaued and has been very gradually heading back up again. As I say, they're broadly stable since July 2022, now trending slowly upwards. I never paid. It's still useful to look at this, but I don't pay the most attention to this as a gauge of underlying value. Obviously, as owners and investors, we are interested in underlying values, not what's the average price of the sales this month. I want to know what is happening to values of potential purchases or the properties I own and so on. Are values going up or down? And the best guide for that is the Real Estate Institute House Price Index. So let's look at that. Here's the league tables here. So for a number of months now, obviously since we hit the peak and started coming off the peak from late 2021, we've been looking at the league tables here, and Wellington has the auspicious benefit of still being in the lead, if you like, of the league tables, in that we have fallen furthest in value since the peak at just over 20% or just under 21%. We were at the trough, we were about 26% down. So we've recovered from 26, I think it's 26 and a tiny bit, like 26.2, I think it might have been, down to 21% down. So we have recovered quite a bit. We were the first to start falling. Wellington's peak was October 2021. On average, New Zealand's peak was November 2021. So we started falling a little ahead of the rest of the country. We fell sharper than the rest of the country too. So we hit the bottom first and have been slowly recovering since then, which is almost a year ago. And the rest of the country kind of continued to drop further away and then has started to recover also. But we are still leading this league tables at the biggest drop since the peak, even after a recovery. Not too dissimilar to Auckland, but still quite a bit deeper than New Zealand overall. And you can see there 20.9% down is a bigger negative number than anywhere else here. What about the last year? So that's interesting. So Wellington is leading the recovery, certainly in the main centres, and leading the recovery almost across the whole country. You can see there that Otago, Queensland, the Lakes, and so on, has recovered more in the last 12 months than Wellington has. Outside of that, Wellington is leading the charge for the last 12 months. ahead of Auckland and easily ahead of the country overall. What about the last 3 months? So very recently, still a reasonably similar picture. So a 2% recovery in the last 3 months, slow, gradual, gentle recovery, but more than most parts in the rest of the country there. In fact, so you can see there that over the last 3 months, none of those regions are more than 2%. So yeah, generally speaking, Wellington has been leading the recovery and started the recovery earliest. So let's look now at the different territorial authorities within the Wellington region. And there's the graph there. So you can see clearly the orange graph is probably the most useful one to look at. That's the cumulative change over a 3-month period. And so you can see there, we really did fall quite a bit over rolling 3-month periods, almost hitting a 10% drop in the 3 months to June 2022. From July, the monthly results were kind of approaching zero, so we were stabilizing from about July, August, and recovered there up to the end of 2022. Then we softened again a bit, but from middle of last year, 2023, strong recovery. And over the last 2 or 3 months we saw a few months plateauing from about August, September, October, November, December, January, a little bit of weakness creeping back in there. So still positive value movements, just not quite the same pace of value movements that we saw sort of midish, latish, August, September, is where we sort of peaked in terms of the growth there in this particular little phase of the cycle. Now, I think someone else is just trying to get in. Hang on a sec. No, I made that up. I've already let them in, it would seem. Okay, yeah, so you can see there 4.6% in the last year, 2% in the last 3 months, negative 2% in the last 1 month. Again, the monthly result can bounce around a bit, as you can easily see. The blue line is the monthly result, goes up, goes down. It's quite a sawtooth. The orange line still bouncy, but not as bouncy as such, as of course it is a collective result over a 3-month period, so it doesn't move quite as fast. What about over the last year? You see there that all territorial authorities in the Wellington region have seen positive growth in values over the last 12 months. Upper Hutt and Wellington leading the charge there with quite decent growth figures there, 7.6% for Upper Hutt, 6% for Wellington City. But, you know, across the board, across the whole of Wellington, generally speaking, growth in values over the last year. So let's now look at some of the other data points here. Number of new listings. Obviously, this is showing us the amount of fresh supply coming to the market. Now, again, December tends to be a very low month. January, we start to see listings coming back, but that's just on a seasonal basis. Averaged out over 6 months, which is the red line there, you can see it looks like we may well have passed the trough, the low point in the number of new listings coming to market. And if you think about it psychologically, late 2021, so around about here, we hit the technical peak in values in October. The levels of activity started slowing down many months before the technical peak in values. I would suggest the 4 to 6 months before the peak in values was hit. So that was coming through from kind of March, April, May. And so we saw once vendors saw, gosh, I think we've hit a peak in values, I better get my house on the market quickly. We saw big lifts in the number of listings coming to market. So you can see that big increase there. But then after a number of months, after they saw either their friends or themselves, or I don't know, a family member or someone they know, whatever, at work, had their house on the market, couldn't sell, took ages to sell, had to take 100,000 less than they thought they might take. Vendors got scared, and so they started going on strike. And then number of new listings returned back down to those kind of norms that we were seeing. And then from September, is what I've been saying, September of 2022, we really saw vendors going on strike. So people sell houses because of life events. These life events don't stop happening, but vendors can delay things for a certain amount of time. And so that's what we're seeing here. We're seeing the life events continue, but the propensity to actually put my house on the market is reducing. And the labour market was still firm. People were not losing their jobs, so people were still earning money. Obviously, there are exceptions to the rule, but that was the rule. Unemployment was not increasing sharply, so people were not en masse being forced to sell from financial pressure. So the option to keep it for a bit longer was there. And so, yeah, vendors were on strike from late-ish 2022. It took a wee while. We started seeing sales taking place again. March, April, reasonably fluently, kind of a bit more of an easing in the market in terms of transactions taking place and multiple offers being received on properties again. Traffic at open homes really strengthening again, and the risk of not selling when you list your property, as long as you're reasonable expectations on your price, then reduced a bit. And now, since late-ish last year, vendors getting that consistent message, we have seen listings returning again, and that is the uptick in the red line there. So for the last 3, 4, 5 months, we've seen more listings starting to come through to the table. Now, more compared to what? More compared to what we were seeing for the previous 12 months. It doesn't mean more compared to what's normal, or doesn't mean excessive numbers of listings, just more compared to what we were seeing in that real starvation period where the vendors were, as I say, on strike. Anyhow, 580 new listings in January versus 527 January 23 and 717 January 22. So 10% more than last January, but still 19% down on January 2022. Of course, January 2022, we were just past that peak in the market. Vendors were saying, quick, we've reached the peak. We're just past the peak. Better get a property on the market. There was a lot of property coming on then. So perhaps not a normal month. Anyhow, there we go. We might be past the low point in the new listings coming to the market. And indeed, you know, if vendors were sort of on strike or semi-on strike for 18 months, 24 months, there is a bit of catch-up that is needed. And at some point, that catch-up will happen. But obviously, vendors are influenced by the degree to which properties are selling and the prices that are being achieved. And look at that, the January number there at 580 since 2015, the January average has been 603 listings a month. So we're pretty close back to what is normal for January since 2015 at least. So that's interesting, kind of heading back to normal January, normal levels of listings for January. And this is the same data looked at in another view. You can see there in December and January, we have seen roughly 10% more listings than we saw 12 months prior, after we saw this real dearth in new listings, far fewer new listings taking place than 12 months prior, which is from September 2022, which is why I've been saying that since September 2022, vendors are on a strike. You can see it quite clearly there. More listings coming to market after the peak happened, then a real starvation, drop off in listings there, and then a recovery, and now we're seeing more new listings coming on again for the last couple of months than we saw 12 months prior. What about number of sales? And this is where we haven't quite seen the commensurate uptick, if you like, in the number of sales taking place. Still more than last year, 314 versus 265. Now remember, January is a month where this is very seasonal, of course. It's just after Christmas, just after holiday season. We don't see a lot of sales taking place in January because listings stop coming to the market from early-ish December. What we do see is in the second half of the month, new listings start to come on, but of course they can't be bought straight away, or a lot of them can't be. They will go to tender, or the auction will close, or the deadline or whatever will close in February. So January tends to be a slow month for sales. We see a big recovery in the number of listings, but we don't see a big recovery in the number of sales in January yet. So compared to most months, January is a low month, and you can see the lows there. There's January, there's January, there's January, there's January. Very, very low sales month. But still 18% up on last January, and only 5% down on the number of sales in January 2022. Now, of course, we were just starting to see sales starting to tail off there. It was just after the peak. Things were slowing down a bit there. So compared to what was already slowish, compared to the boom crazy times, but nonetheless, interesting to see up considerably on last year and back to the same level we were 2 years ago for January at least. And there we see the normal for a January since 2015 is 420. So although we're 18% up on last year, we're still well short of where we would normally be in a January. And you can see there that we have been short for January, well, since January 2020. So, interesting that, well, before then, of course, it was boom times. And so we were seeing more sales and so on. Anyhow, yeah, still an uptick compared to last year. And there's the same numbers. So although the numbers are low compared to what's normal, we have seen more sales taking place in November, December, and January, 15 to 20% more than we saw 12 months prior. So the number of sales, the sales volumes are recovering, but we're still below what would be a normal, healthy, balanced sort of market. What about duration to sell? So 46 days in January. Again, January is an unusual month. If you think about it, the properties that sell in January, the vast majority of them at the latest were listed in middle of December. So there is typically the ones that sell in January, they've been listed since October, November, December, because there are no fresh ones very recently. It always happens. So 46 days there compared to 62 last January. That's obviously a big drop down. 49 days 2 years ago. So again, January's result this year, not too dissimilar to what we saw 2 years ago. And compared to what's average in January, at 43 days, again, slightly longer than what's average. So similar to the other results we're seeing, we're getting close back to normal, not quite as strong as normal, but not far from it. And inventory, 12 weeks in January versus 18 a year ago and 14 2 years ago. So interesting again, at 12 weeks, less inventory than we saw 2 years ago. So this is by no means a hard market for sellers. If you look at these metrics, we're sort of in normalish territory. And at 12 weeks, we're below what's normal. So technically a seller's market. But at 12 weeks, it's less pronounced a seller's market than we saw, say, in July, August, September last year, October, where we saw 10 to 11 weeks worth of supply. Average is 15. 10 to 11 weeks is significantly below average, not nearly as below average as we saw during all these boom times here, even as low as sort of 5, 6, 7 weeks being quite common throughout late 2020, throughout 2021, until we hit that peak and things started to go up again there. But so yeah, 12 weeks, a drop down from November, December, back down to the levels we sort of saw mid to late-ish, or approaching those levels at least, mid to late-ish 2023. So technically a seller's market, but only just a reasonably balanced kind of seller's market. TradeMe listings, you can see there, very, very similar levels of listings in January this is February, of course, as of a couple of days ago, as we saw a year ago and 2 years ago. So fairly stable on that basis. You can see the general shape of things there. Once we reached the peak and we saw a lot of properties coming to market at the same time as buyers decided, whoops, I am pulling back. All the vendors came forward, all the buyers came back. The amount of stock on the market absolutely ballooned. Went up by about 160% at one point. Then it bounced around with seasonal sort of normal patterns. Then it dropped off middle of last year as some strength was returning back to the market. Vendors were still on strike. Those new listings weren't coming forward. Buyers were seeing that prices had stopped falling. Interest rates probably approaching their peak. I'm going to step forward. I'm going to make transactions here, and stock was eroded away. Then the vendors started to see that, gosh, things are selling in, and they brought their properties to the market, and stock returns again. So as I say there, the stock levels have increased as the sales have failed to keep up with the new listing volumes. Will they start to now increase? I suspect in February we'll see a big jump up in number of sales taking place as all this new stock is coming on. And boy, we have really started to see a large number of new listings coming on in February. That is for sure. And there's the same data in another form. So you can see there we had considerably fewer listings for a number of months throughout 2023, and then the difference returned back to parity over the last couple of months, and so we're broadly at the same level as 12 months ago now, after having a massive increase and then a small decrease and back to parity. So, folks, in summary, Wellington values have continued to increase in the last few months, but those increases have moderated compared to what we saw mid to late-ish 2023. New listings have increased almost back to seasonal norms. Sale volumes have also increased, but still low compared to what is normal. Duration to sell is long, as is typically the case for January, so that's quite normal. Inventory remains low. It is still a seller's market, just not as aggressively as we saw sort of late-ish last year. TradeMe listings are level with last February and indeed the February before, broadly speaking. So if you're thinking of selling out there, market's still reasonably healthy. The market strength and the price rises, though, have both eased in the last couple of months. But buyers don't wait for things to improve. And a big thanks, of course, as usual, to Real Estate Institute and realestate.co. I don't have more economic kind of updates for you this time. Hopefully I will next time. It has been rather mad, busy entering back into selling season as we've come out of the new year. So apologies for that. But happy to take questions, discussions, points of interest. What are you seeing out there?
Hey, how are you finding the rental market near city suburbs like Toronto, Brooklyn, Wadestown, and the likes? Are the people still like the rental demand is quite high, or it's still struggling?
Yeah, that's a good question. Now, obviously, I'm not a property manager, but I am close to the rental market through my relationship with Powell & Co. And obviously, I'm an investor myself. And I also watch John Butt's rental data, which he does a really good job of analysing. And what I've seen anecdotally and personally is that for about 18 months, especially the big places, because I tend to own larger properties in city fringe locations that suit either mature students maybe, or first, YoPros, first jobs out of university, the 20, 22, 24-year-olds. And there's been real weakness in that market. And Peter Ambrose has done a bit of research on that in terms of looking at the student numbers, particularly at Victoria. And yeah, Victoria has been really struggling. And so those, I couldn't tell you the numbers, but the student numbers are down significantly. And so that segment of the market in particular has been very, very soft. The Wellington market generally has been soft as well, but that segment has been really soft. And I know, for example, I had a 5-bedroom, 2-bathroom house with a flat under it on Adelaide Road in Newtown. And we were renting that for was it 11? I think it was $11.75 a week, like 2 years ago. And the tenants moved out, and it was a bit scruffy. So we actually spent 20 or 30,000 new floor coverings, new window dressings, new LED lights throughout, new paint, and some certifications to bathrooms and so on to make sure everything was working and all clean and tidy and everything. So we improved it. And we had to drop the rent slightly to $1,100. That was about 2 years ago. And then one of our tenants had a bit of a real hard personal, well, they had a hard personal situation with one of their tenants, and so we kind of allowed them to break their tenancy for compassionate reasons in I think it was June of last year. And this is winter time and not an ideal time to be renting a 5-bedroom, 2-bathroom in Newtown. But we were not expecting it to be as hard as it was, and we ended up having to rent this place for $900 a week. So yeah, that's just a sign of how soft it is. And I know I speak to Peter Ambrose reasonably frequently, and he has also indicated that he's had a lot of difficulty. And of course, in my discussions with Keith from Powell & Co. and my property manager and so on, they're saying the same sort of thing. The rental data I'm watching that John Butt very helpfully puts together has shown that rental market generally has been weak. And the best indicator I've seen that as one indicator to give an overall guide to how the strength of the market is vacancy rate. So normal healthy vacancy rate is about 2.5%. And so that is something like, what's 2.5% of, so it's 1.25 weeks vacancy per property per annum. And so if you've got more than 2.5% vacancy, then you've got a soggy market, you've got a bit of oversupply compared to what's normal. If you are under that, then you've got a very tight supply, and then rents will go up. If it's soggy, rents will soften or plateau. And so, yeah, we've seen it go from, I couldn't tell you the exact numbers, but more than 2.5% has in Wellington. Now, it's interesting because the rest of the whole North Island, pretty much everywhere else in the North Island, has been at normal levels or tight. So Wellington has really been the standout market in the wrong direction, for owners at least. Good news for tenants. But in the last 6 months, that excess has returned back to normal. So we have been in a strengthening rental market for the last 6 months, and it certainly has felt that way too on the ground in my discussions with the team at Powell & Co. And in dealing with my own renewals around the New Year period as well. So I don't know if that helps, but that's been my experience.
No, it helps quite a lot. And honestly, I've seen, this is the first time I've seen Peter advertising his property on big deals, which
Yes.
is quite rare.
Yeah. So, but look, this is an important consideration for investors generally. If you are chasing assets that deliver a high yield, there normally is some risk. And so that segment of the market, what you're dealing with is properties that have a large number of bedrooms, large number of bathrooms. They'll accommodate a lot of people. Your 30-year-olds that are earning good money and in perhaps an established partnership, relationship sort of thing, they don't want to live in a property like that. You're dealing with a particular segment. It's young people, first job out of university, or students at university. And so one of the risks of that segment is it's very seasonal. So there's a lot of strength in the demand in January and February, March to a certain degree, and then a little bit also in November sort of time. Middle of winter, it's like being becalmed. If you're a sailor, you're out there in the ocean, there's not a breeze. So if you get a vacancy then, you have to take a hit on your income for a period of time until you can get back to that normal 12-month cycle. And of course, the change in the Residential Tenancies Act that said you could only do one, that you had to offer a periodic tenancies. That's a real burden for this sort of market, but also that you can only change the rent once every 12 months. So that if you miss that peak market, you can't do it again until after the peak market. So you have to wait almost 2 years for that to come around. And those rules, of course, might change. But that's one of the peculiarities of that segment of the market. The other one is, of course, that when the market weakens, when the heat comes out of when the demand falls for the market generally, it is these ones that are on the edge of what's normal that will suffer far more. And so your rent, if the market rent suffers 2%, the rent for those properties might suffer 20. I mean, 20 is a lot, but it might suffer 10%, it might suffer 20 for a period of time. And but that's not a problem as long as you understand that that's to be expected when you get these periodic these softening periods in the cycle. So it's like if you're going to chase those high yield investments, you can't expect that high yield to be as stable. So as long as you have built that fat into your system and into your numbers, and you're not counting on that high yield to be completely stable, then you're okay. As Warren Buffett says, I would rather have a bumpy 15% than a smooth 12%. So you just run into trouble when you assume that high cash flow is going to be there reliably, consistently for a long time. You have to allow for some of that variability, so you've got the ability to absorb those knocks in the market. Another very famous investment expression is, have you heard of the 6-foot man who drowned crossing a river that was 5 foot deep on average? It's not the average that you need to be able to survive. It's the troughs you need to be able to survive. So anyway, I hope that helps. Now, there's a couple of questions here. Could you please add a link in the chat for who you mentioned does rental analysis? No, because I don't know off the top of my head what that URL is. But if you search for John Butt, that's his name. And he's a Wellington investor, obviously a bit of a data analyst like myself, and he tracks the rental data, not just for Wellington, but for New Zealand. But he is a Wellingtonian. He lives out in Eastbourne, I think it is. So he does really good work. He has a blog there and updates his charts frequently and so on. So that's very interesting. Craig, I heard it was mostly OO. What's OO? Who have recently got their residence status rather than New Zealand citizens who have been buying. What have you seen? Overseas people, is that? Mostly who have recently got their residence status rather than New Zealand citizens. No, it's just regular people getting on with life. It's just it's the most active group of first home buyers. CoreLogic data, I think, shows 27% of sales in recent months have been going to first home buyers, and that's the biggest share. That's their biggest market share for some years. I can't remember what their normal share is, but these things don't move enormously. But if it's normally 24 and it goes to 27, then that's a big change. But anyway, yeah, first home buyers are the most active. Investors are pretty dormant, and otherwise it's just movers. So no, Wellington doesn't get massive immigration. Massive immigration goes to Auckland first, and then it can filter through the country as they move around a little bit. I mean, we get our share, of course, but it's not a huge segment of the market like it is in Auckland. So no, I personally haven't been dealing with any new immigrants. I don't think that I've seen some of the open homes and people returning back to New Zealand, but no, nothing more than normal. I don't think, Craig. Yeah. All right, folks. Well, that's it. I'll check out for until next month. Next month, as I say, I'll try and get some more general economic indicators. Things are quietening down a little bit compared to the last month. And so I'll get back on that train. But yeah, otherwise, if you need personal advice or whatever, obviously, I want to sell your property, give us a call. You know where to find me. Otherwise, best luck out there, and let us know if I can help in any way. And I might see you at the property investor meeting. All right. Cheers. Bye bye.